Alistair, before I ask the next question, I'm just going to bring up some figures that I saw today. They're from Michael Oliver, and he gives me 3 time periods on where the price of gold is obviously is being valued in dollars, but against the major difference is the gold price, and there's the S&P 500 price, the share price, S&P 500. So the first one was year to date, so January of this year right through to now. Gold price is up 31% and the S&P 500 9%. 2022, 2025, 3-year period, gold price is up 95%, the S&P 500 55%. So you can just see gold being quite a better way of better holding money. But the year 2000, 25 years ago to 2025, gold is up 1,200% as against S&P 500 350%. These figures you actually never hear about until you listen to Michael Oliver on King World News. So my question is, Alistair, I personally hold 80% of all assets in physical gold and silver, and 20% in gold mining shares. I was once told that I have all my eggs in one basket, and my reply was, gold and silver are money, everything else is credit. How would you have answered that same question?
I think I would have broadly said the same thing. But it is worth noting that people think, as you just pointed out, that having gold as part of a balanced portfolio is putting too much into one basket and not enough in others. In other words, the way they look at risk is that risk is something which is individual to investments. What they don't realize is that if you have everything in credit, then you're not diversified at all. And this is a point which, of course, the whole of the investment management industry just does not understand. The investment management industry think that dollars are money, when in fact it's a form of credit. It is the highest form of credit indeed. And when you look at other investments, so-called risk-free investments, they say that US Treasuries are the risk-free investment. No, they're not. And we're seeing escalating risk. Why is it that investors, if you like, foreign investors in particular, are not buying long-duration US Treasury bonds? Well, obviously, they see risk. So what do they want? They want to see a higher return. So that means that bond yields have to rise. Now, if you're a hapless investor in this risk-free investment, you start losing money. The whole of the investment management industry's credo about what is risk and what isn't risk actually is fundamentally flawed. And if you're going to really protect your investments, your wealth, then you've got to think rather differently. You've got to understand that to have everything in credit is not diversification. You might diversify between different sorts of credit, but you're missing the point that it is credit which is the risk more than anything else. And that will undermine everything if credit collapses in terms of its value. So I think that, the comment that you're putting all your eggs into one basket is actually misplaced and misunderstands the difference between money and credit.
Well, I'm glad you answered the question, because it was done a lot better than mine. But it all goes back to the same thing, the same meaning.